All right, Steve. Well, here we are doing something maybe we didn't think we were going to do, and that's to
hmm
start to post videos around, a lot of the things that we're talking with each other about, the community about, our clients about, and making that something that clients want and other people in the community would want to start to listen to. And I know for us, one of the reasons that we started really brainstorming these video series is to bring people some of the pop culture, things that we're
hmm
hearing, stuff that we're
hmm
talking to clients about, things we're hearing in the relationships that we have. And also, even things that we're seeing in the news around social media and really bringing those ideas and perspectives to clients in a way that maybe they haven't seen or heard before. And, obviously we can't forget that we're financial planners and investment advisors. And so wanting to make sure we're bringing relevant content around those topics as well. So maybe we can get things started. What are some things that you're reading or hearing about that
hmm
you think we should be talking about today?
Yeah, well, we put out a good article, and you worked a lot on the article last month's newsletter about the new Trump
Hmm.
accounts, and we continue to get some interesting questions around that, and one of them is like, well, how does this compare to a 529 or other accounts that we could invest in? So, um, curious what your thoughts are.
Throwing it to me. All right. I think as I've had some recent conversations with clients and just even some friends, people want to boil it down. Like, what is what does this mean for me? And I think the big thing is if your kid isn't born after January 1st of 2025, you're not going to get the $1,000 government
hmm
contribution. And that's where you start to get into like splitting hairs around, is it worth it? Is it not? If you've got a kid or a grandkid that's born after that date, then help fund that account, or start the account to get the $1,000 funding. I think that's a good way to do it. But as we start to get into like, well, do I contribute to a 529?
hmm
Um, I personally like the flexibility of the 529, much
Right,
higher contribution limit. So $5,000 is the cap on the Trump account, and that's per beneficiary.
right, right.
Whereas with the 529, I can contribute up to $19,000 a year. Other people can contribute,
hmm
up to those annual gift amounts. So I think there's a lot more flexibility there, plus investment flexibility. And even now, we've got the ability to convert from 529 to Roth. Obviously, there's some rules around that. So
Right.
I think, if you're somebody that's, got a kid, again, born after the January 1st, 2025 date, I think it's free money. Go ahead and give it. If
Right.
your employer, there's rules now around this where employers can make contributions to Trump accounts. And if you got someone like basically doing like a 401k match,
Mm.
sure, it's free money. But I think there's other accounts where if you're really looking to maximize savings for kids, and especially if you're even wanting to go above and beyond the 529, there are account types that we haven't really talked as much about with clients, but the UTMA and UGMA accounts, which are ways to transfer money, to kids. But I will say in those examples, that Trump account is more like an IRA, gives you a little bit,
Right.
some tax shelter on there. So I don't know if that is helpful.
Right. Yeah. No, that's helpful, and I think we'll continue to get questions from clients around that. Another thing we're hearing about is home buying. The expense of it, and trying to secure a good mortgage rate.
Hmm.
So curious what your thoughts are on that.
Well, I mean, I think it's a lot of it is driven by interest rates, and
Right.
I know, in kind of like the news sphere, you hear a lot about the Fed and lowering rates, and obviously, lower rates tends to be stimulative, but the short end of the rate piece, which
hmm
the Fed is what's controlling, doesn't really actually drive much of
Right.
the lending, the things that actually impact people like you and I and all of our clients and friends. Maybe chime a little bit in on, what's really driving the affordability around
Yeah,
mortgages.
yeah. I've heard from a couple of friends who are looking to buy and move and so forth, and looking at the mortgage rates and the volatility of them, and it really comes down to the long-term Treasury rates, 10
Hmm.
years plus, and we've seen a lot of volatility recently because of what's going on in the Middle East, the concerns around inflation spiking again, which is like the worst enemy of bond
Yeah.
investors, and so that'll send Treasury prices down and yields up. But then the next day, the bond market might be worried about economic growth. All of this, uncertainty and increase in different prices, not just oil, but all of the refined products that come out of oil, can lead to inflation pressures, and that can, curtail spending. And so then, maybe people hold back on growth activities, spending money, companies hold back on on investing in new capital equipment and so forth. And so it's that tug of war going on in the bond market right now between, economic contraction and slowdown versus inflationary pressures. And that's, really throwing the mortgage rates up and down like crazy. So hopefully there'll be some resolution to that soon.
So the note for everybody is to actually bookmark the 10-year treasury, start studying that, and maybe time your home buying
Right,
to that.
right. Try to lock in a good rate.
Yeah.
Yeah.
Well, obviously, I kind of mentioned it at the beginning, but, we wouldn't be good advisors if we weren't talking a little bit about what's going on in the markets. And obviously, a lot of the more recent news is around, what's going on in the Middle East and in Iran and the implications of all of that. Maybe talk about a few things. Obviously, we're not geopolitical experts, but,
Right.
maybe kind of from a financial planning investment standpoint, what we should be thinking about.
Yeah, and we've received, a few calls from clients, and as we talk to friends and family, a common question is, well, gee, shouldn't we do something about it? Reduce the risk, and that's a natural feeling to have when there's this kind of, surprising negative news, whether it's a war or some kind of disappointing economic data. And, it's natural to feel like you need to do something. And because, losses or declines in value kind of, for most people, feel worse than when things are rosy and increasing, they feel worse than gains.
And if I can interrupt, there's
Yeah.
actually a behavioral bias term called loss aversion, which
Mhm.
is that we actually as humans feel pain 2 times more than we feel
Right,
rewards.
right. And so, I think people need to remember that investing is a long-term thing. It's not meant to be,
Mhm.
short-term thing like gambling or speculating. And when we look at market history, it's pretty clear that a lot of the big gains, happen right after a loss, and volatility is normal. And so, you know, when you look at history, it's kind of pretty clear that it's counterproductive to try to get in and out just to make yourself feel good, because once you get out, then the harder decision is when to get back in, as you know. And so, take a look at this chart of the S&P 500 performance from 2005 to 25, showing the effect of missing some of the best days versus just staying invested. And you can see how in this time period, missing only 10 days, the 10 best days, means your return would have been less than half of staying fully invested. And often, as we've seen recently, the best days occur soon after the worst days. So if you sell out of the market at a low point, thinking you're cutting your losses and you're going to feel good, but then you have to decide when to get back in. So the solution is to develop a comprehensive plan and then invest in a well-diversified, customized portfolio that's built around your time frames. And that can help dampen the volatility and still offer good long-term, return potential over time. And that will bolster your confidence to help, ride out the inevitable volatility.
Yeah, I was just meeting with people this morning, and we were talking about March end statement values, and then
Hmm.
April 1st, and then April 2nd. You have like a 3.5% move, and then followed by another 1% move, and I think that
Right.
underscores, the reality
Hmm.
that if someone would have said, I looked at their March end statement and been like, okay, I'm out. You
Hmm.
miss out on some of that recovery, and it's that timing impact that we got to really be careful about. 'Cause I think even if we go back to people like us that were helping clients invest in the financial crisis, that was a really, and this is not the financial crisis. I want to make it very clear for people, but just the behavioral aspect of, when we
Hmm.
talked about loss aversion, but there's also another behavioral term called action bias. We just feel as humans like we got to do
Right.
something. And sometimes not doing something is actually the best thing. And I know in the financial crisis, people might have gotten out. And then as markets start to recover, they go, well, there's got to be another shoe that drops.
Hmm.
There's got to
Hmm.
be something else. And all of a sudden it's just really too late. And that's really where you lose out on, I think the long-term wealth creation effects that cost people.
Yeah. So again, it comes down to proper planning. And so if you can feel good that your long-term money really is long-term money and you've got enough short-term
Mhm.
money to meet your short-term goals, that can really make you feel better. And, remember the stuff that we're building the portfolio in the beginning, that's the hard work. And that's, where you're building a portfolio that can withstand volatility and, like I said, still offer good potential. And so, do the proactive planning up front, and that'll help you sleep better at night.
Yeah. Well, thanks for sharing some of those things. I, know we wanted to keep, this conversation a little bit shorter to kick things off. But what we do know is that people are really interested in this idea of micro learning, where we're not dedicating a lot of time to read something. We do like our little short clips, but people are really interested in spending a little bit more time hearing some more detailed discussion on the things that are important. And so I would just offer up to anybody that's watching and listening, reach out to us and let us know what would be helpful for you to talk about. We can think about things that we think are important, but if it's not what people really want to hear,
Exactly.
that doesn't do us any good. So as we start to create these again, we would love your feedback. And as the YouTubers of the world now say, like and subscribe and keep following us for more.